All right, this isn't a technical pullback. This isn't an ETF flow story. This is geopolitics. The Middle East conflict has entered its fourth day. U.S. and Israeli strikes, confirmed death of Iran's supreme leader, retaliatory missile and drone attacks across the region, explosions reported in Gulf states. And now, markets are reacting accordingly. Oil is surging, Brent pushing toward 14-month highs, Dow futures down 5 to 700 points, European and Asian markets off 3 to 7%. This is classic risk off. And crypto is not immune. Bitcoin dipped below $66,000 earlier and is now chopping between roughly $66,800 and $68,600. Not collapsing, not rallying, holding. Gold and oil are acting like hedges. Crypto is behaving like an equity proxy. And that debate, digital gold versus risk asset, is back in full force. Today we're breaking down the war escalation and what it means for global liquidity, oil and Hormuz risks, why equities are tumbling, why Bitcoin miners are quietly adding structural pressure, and whether BTC's relative strength near $68,000 actually matters. This is not a hype day. This is a positioning day. Let's get into it.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, let's look at the board. This is not a technical-driven market today. This is macro. This is geopolitical. And crypto is reacting accordingly. Bitcoin is currently trading in the $66,800 to $68,600 range after briefly dipping below $66,000 earlier during peak escalation headlines. We're sitting around $68,000 as of this recording. That's down roughly 1 to 4% intraday, depending on the wick you measure. Technically, 2-hour structure still range-bound, lower highs intact. $70,000 remains resistance, $65,000 to $66,000 is near-term support. Momentum indicators are neutral to weak, no strong bullish impulse. This is stabilization, not strength. Ethereum hovering near $1,990 to $2,000, also down modestly on the day, still trading below key moving averages on the 2-hour. No leadership from ETH here. When ETH doesn't lead, markets rarely explode upward. Solana around $85 to $86, holding better than some mid-caps, but still trapped inside a sideways compression channel. No breakout attempt, just defensive positioning. XRP near $1.37, still structurally weaker compared to BTC dominant strength. Oscillators choppy, nothing decisive. Total crypto market cap, approximately $2.34 trillion, down about 1% on the day. 24-hour volume elevated, around $118 billion plus. That's defensive repositioning volume, not euphoric buying. Now, the Fear and Greed Index, currently reading 20. Fear, not single-digit panic, but still firmly risk-off. Last week, we were printing extreme fear. Today is not relief. Today is cautious survival. And where is Bitcoin dominance? Currently sitting around 58.6%. That's important. Capital is consolidating into Bitcoin, not rotating into alts. This is defensive dominance expansion, classic risk-off crypto behavior. Dow futures down 500 plus. European markets off 3 to 7%. Oil surging toward multi-month highs. Brent pushing above $82. Strait of Hormuz risk is the headline driver. Markets are pricing energy shock risk. And when oil spikes, liquidity tightens. Risk compresses. Negative funding rates printed earlier in the move. That tells us traders are leaning short, which means short squeeze potential exists, but it's not active yet. So, what matters now? Can BTC hold $66,000? Does $70,000 flip back to support? Does oil continue surging? Do equities stabilize? Right now, crypto is behaving like an equity proxy, not digital gold. Relative strength versus stocks is mildly encouraging, but this is still a war-driven macro tape. We're not in a panic spiral, but we are absolutely in defensive posture. After the break, we'll get into what is causing all of this. Stay with me.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, welcome back. Now, the escalating Middle East conflict is the single biggest force driving markets right now. This is not a rumor cycle. This is not social media noise. This is kinetic escalation. The conflict has entered its fourth day. U.S. and Israeli forces conducted major combat operations inside Iran. Initial strikes reportedly killed Supreme Leader Ayatollah Ali Khamenei. Iran responded. Missile and drone attacks hit Israel, U.S. regional bases, and Gulf allies, including Qatar, the UAE, and Bahrain. Explosions were reported in Dubai and other Gulf sites. President Trump confirmed U.S. involvement and warned of, quote, force never seen before. This is escalation at the state level, not proxy theater. Now here's where markets start sweating. The Strait of Hormuz handles roughly 20% of global oil transit. If that corridor closes, oil spikes, energy costs surge, inflation expectations jump, liquidity tightens, and risk assets compress. Brent is already pushing above $82. If Hormuz closes, $100 oil is not extreme. That becomes a liquidity shock. Dow futures down 500 plus. European and Asian markets off 3 to 7%. Cyclicals hit hardest. Bond flows increasing. Classic flight to safety posture. Gold and oil surge. Crypto? Crypto behaves like equities. Bitcoin dipped below $66,000 earlier, now stabilizing between $66,800 and $68,600, down 1 to 4% intraday in spots. Not collapsing, but not acting like digital gold either. In war escalation scenarios, institutions reduce risk exposure, leverage decreases, funding turns negative, spot demand softens. Bitcoin becomes a beta asset, not a hedge, at least initially. That's what we're seeing right now. Bitcoin dominance rising toward 58.6%, capital consolidating into BTC, alts lagging. This is defensive crypto positioning. One interesting data point, polymarket volume hit a record $478 million in a single day, $220 million of that on politics alone. Some wallets tied to early positioning reportedly profited heavily. War volatility is monetizable, and prediction markets are absorbing massive speculative flow. That tells you something. Liquidity doesn't disappear, it reallocates. Long-standing U.S.-Iran tensions, proxy conflicts, energy leverage, and an aggressive U.S. response posture. The strategic objective? Neutralize perceived threats. The unintended consequence? Global market shock. Now, where does this go next? Short-term escalation. Hormuz closure risk rises. Oil to $100 plus. BTC likely tests $60,000 or below. Broader equities deepen losses. De-escalation. Ceasefire headlines. Oil pulls back. Risk on snap rally. BTC squeezes shorts toward $72,000 to $75,000 quickly. Right now, markets are pricing risk expansion, not resolution. Crypto is not collapsing, but it is behaving like a high beta asset inside a geopolitical storm. Liquidity contracts first. Conviction returns later. And until oil stabilizes, Bitcoin remains correlated. When we come back, let's talk about oil, because if the Strait of Hormuz becomes more than a headline, energy prices may end up dictating what Bitcoin does next. We'll be right back.
Some mornings start quiet. No rush, no noise. Just good people and the decision to roll forward.
All right, welcome back. Let's talk about the lever that's really moving markets right now, oil. Brent crude is approaching $82, up more than $10 since Friday. That's a 14-month high. U.S. crude is pushing roughly $75.55, an 8-month high. This surge accelerated between March 1st and today, March 3rd, as the conflict escalated over the weekend. This is not speculation. This is supply fear. So, why does oil matter so much? The Strait of Hormuz handles roughly 20 million barrels per day. That's about 20% of global oil flow. If that corridor closes, even partially, energy shock, shipping shock, inflation shock, and liquidity shock. That's the chain reaction. Who's driving this, you ask? OPEC nations, U.S. and Iranian militaries, Saudi Arabia and UAE infrastructure risk, global energy traders, speculators positioning for disruption. And remember, explosions were reported in Dubai. That adds real, not theoretical, supply concern. Markets are pricing potential disruption now. Now, why does this pressure crypto? Well, oil spikes tighten financial conditions. Higher energy costs mean higher inflation expectations, fewer rate cuts, higher capital costs, lower liquidity. Crypto trades as a liquidity asset, not a bunker asset. Bitcoin dipped below $66,000 earlier. That happened during peak oil acceleration headlines. Funding rates printed as low as negative 6% at one point. That tells us something important. Traders are aggressively shorting, which means short squeeze potential exists. But it also means bearish conviction is real. When oil rises sharply in a geopolitical shock, central banks hesitate, risk compresses, high beta assets bleed. That includes crypto, at least in the short term. So, what happens next? If Hormuz closes, oil to $100 plus is realistic. That likely pushes BTC toward the low $60,000, maybe even high $50,000 if panic spreads. If the U.S. releases reserves or de-escalation talks begin, oil cools, shorts unwind, crypto squeezes hard. Energy is the throttle right now, and until oil stabilizes, crypto remains in defensive posture. This isn't about chart patterns. This is about barrels per day. And right now, the barrel is winning. When we come back, let's widen the lens, because it's not just oil reacting. Global equities are tumbling, and crypto companies themselves are taking hits. We'll break down how deep that correlation runs. We'll be right back.
She redefined what it meant to race without limits. She proved that silence could be louder than words. Fearless, fast, focused. A reminder that champions are built on grit. That same intensity now fuels her signature blend. Roosted and roasted. Bold Italian roast crafted with the spirit of champions. Ashley's Roosted and Roasted, only at wholeshotcoffee.com.
Okay, now let's zoom out, because this isn't just an oil story. This is a global equity story. Wall Street futures are down 400 to 700 points on the Dow. European indices off 3 to 7%. Asia hit hardest. South Korea's Kospi down 7%. All 11 S&P sectors red. Cyclicals and rate-sensitive sectors getting hit the hardest. This is broad liquidation, not selective rotation. So, who's moving the market? Retail investors rotating to cash, institutions reducing exposure, funds de-risking into bonds and short-duration instruments. And here's where it gets interesting. Crypto-linked equities are bleeding too. Strategy down roughly 3.7% pre-market. Robinhood down about 4.7%. Coinbase off around 3.8%. Crypto companies trading exactly like growth stocks, because in this environment, they are. Now, why is crypto following equities? War expands risk premium. Oil surges. Inflation expectations rise. Liquidity tightens. And what gets sold first? High beta assets. Crypto, tech, growth, anything sensitive to capital flows. Bitcoin dipped below $66,000 earlier. ETH under pressure. Solana compressing. That move coincided directly with futures weakness. Correlation remains high. Now here's the nuance. Bitcoin did retake $68,000 briefly. That's relative strength compared to equities. Crypto isn't collapsing. It's stabilizing faster than some stock indices. But make no mistake, this is still risk off. In geopolitical escalations, markets price, supply chain disruption, energy inflation, policy uncertainty, reduced global growth. That widens risk spreads. When spreads widen, liquidity shrinks, and crypto trades on liquidity. So what happens next if de-escalation headlines hit? Equities could rebound 5 to 10% in a single session. Crypto likely squeezes harder. If conflict expands, markets test lower, and 2022-style volatility returns quickly. Right now, we are in defensive posture across global markets. Crypto is not immune. The digital asset market still lives inside the global liquidity system, and until equities stabilize, crypto remains correlated. When we come back, let's address something uncomfortable, because gold, the supposed safe haven, is acting strangely, and that has implications for the digital gold narrative. We'll unpack that next. We'll be right back.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, picking up where we left off. So, here's the twist. Because if you expected gold to explode higher during a war escalation, that didn't happen. Gold and silver had surged to historic highs before the conflict widened, but over the last 24 to 48 hours, they pulled back. Gold down roughly 0.9 to 1.4%, silver showing similar weakness. This retreat accelerated between March 2nd and today, March 3rd, and that surprised a lot of traders. And who's rotating? Gold traders, safe haven investors, macro desks, and here's the key. Capital rotated not into metals, but into bonds and cash, ultra-safe positioning, treasuries, short-duration instruments, liquidity preference over commodity exposure. So why is this happening? War increases inflation expectations. Higher oil pushes capital costs up. Higher capital costs make non-yielding assets less attractive. Gold doesn't produce yield. Bitcoin doesn't produce yield. When rates are expected to stay higher for longer, yield-bearing assets win. That's the mechanical explanation. Now this is where the debate gets loud. If gold isn't acting like a safe haven, Bitcoin won't either, at least not immediately. The digital gold thesis doesn't activate during acute liquidity shocks. It activates after stabilization. Right now, Bitcoin is trading like a growth asset, not a bunker asset, and gold just reinforced that reality. This adds fuel to the bearish narrative. Critics will say, see, Bitcoin isn't a hedge. But here's the nuance. Safe haven flows happen in phases. Phase 1, cash and bonds. Phase 2, selective commodity flows. Phase 3, alternative hedges. We are still in phase 1. So what happens next? If de-escalation headlines hit, gold likely rebounds. Bitcoin likely rebounds harder. If conflict persists and inflation expectations remain high, metals could flip higher again. But until rate expectations stabilize, yield dominates the conversation. The safe haven story is not dead, it's just early. And in early war volatility, cash wins. When we come back, there's another structural pressure building inside crypto itself. Public Bitcoin miners are pivoting to AI infrastructure, and they're selling BTC to do it. That supply shift matters more than most people realize. We'll break that down next. Stay with me.
Monday morning starts here, coffee in hand, ready for the grind. Leaving the bike behind, chasing the week ahead. Fueled by the passion to ride and the coffee that gets us there. Whole Shot Coffee. Fuel your life.
All right, let's talk about something internal to crypto, because not all of today's pressure is geopolitical. Some of it is structural. Public Bitcoin miners are pivoting. Core Scientific, CleanSpark, Riot, several North American operators, they're reallocating capital away from BTC treasuries and toward AI infrastructure buildouts. Over 15,000 BTC sold recently, and analysts at Hashrate Index suggest more may follow. This shift accelerated between February 20th and today, March 3rd. So why are they doing this? Post-halving rewards are thinner. Bitcoin prices are not at euphoric highs. Energy costs are rising, especially with oil surging. Profit margins are compressed. So miners are asking a simple question. Where can this power generate more yield? Right now, AI data center contracts look attractive. Higher margin, more predictable revenue. So they're monetizing BTC reserves to fund that pivot. Now, what does this mean for Bitcoin? Miners are natural sellers, but historically, they've also been long-term holders during bull cycles. When miners reduce HODL pressure, supply increases. That creates structural headwinds, especially during macro stress. This is not panic selling, this is strategic selling, which makes it more persistent. Now, looking at the bigger picture, war-driven volatility, oil-driven liquidity tightening, and now miner-driven supply increase. Those forces stack. That doesn't mean collapse, but it does mean rallies may face overhead resistance. Every bounce must absorb real supply. Now, here's the nuance. The AI pivot could stabilize these companies long-term. Diversified revenue, stronger balance sheets, reduced reliance on pure BTC price cycles. That may ultimately strengthen the ecosystem. But short-term, it weighs on price. If BTC stabilizes above key levels, miner selling slows. If BTC drops towards $60,000 or lower, expect additional treasury liquidations. This is something traders must factor into supply dynamics now. Not all pressure is emotional. Some of it is mechanical. And mechanical pressure tends to persist longer than headlines. When we come back, let's lighten the tone a little. It's time for the Proof-of-Thought Mailbag. Questions, comments, roasts, and a little clarity in the middle of chaos. We'll be right back.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
And we're back. All right. Markets are tense. Oil's climbing. Bitcoin's wobbling. So naturally, it's time to read the comments. Let's do this. First question is from @MacroMaverick and asks, if BTC doesn't act like digital gold during a war, what's the point? Yes, the classic. Here's the point. In acute shocks, liquidity wins. Cash and bonds move first. Safe haven narratives activate later. Bitcoin is still a high beta liquidity asset. It becomes digital gold in monetary debasement cycles, not missile cycles. Timing matters. Next one is from @oil to100 and says, $100 oil incoming. BTC under $55,000 next. Confident. I respect it. If Hormuz closes, yes, oil spikes. But markets overshoot fear. Negative funding already printed near minus 6%. That means traders are leaning short. And when positioning gets one-sided, squeezes happen. Don't marry a panic thesis. This question comes from @DiamondHands420 and reads, miners selling, so we're doomed? Doomed is dramatic. Miners selling 15,000 BTC sounds huge, but context matters. Daily volume is over $100 billion. This is pressure, not apocalypse. Strategic reallocation isn't capitulation. Big difference. Okay, @Equity Escape asks, why is crypto still following stocks? I thought it was decentralized. It is decentralized. It is not deliquified. Global capital pools move together during risk compression. Correlation rises in crisis, it falls during expansion. Decentralized networks still live inside centralized capital markets. That's the uncomfortable truth. At Polymarket Pro says, prediction markets are printing money right now. Some are, most aren't. For every wallet that profits on volatility, dozens get liquidated chasing it. Volatility rewards discipline. It punishes emotion. Same as trading. Hey, last one for today is from @StillStacking and asks, should I just keep DCAing and ignore the noise? If your time horizon is years, yes. If your time horizon is hours, no. There's a difference between investing and trading. War volatility shakes traders. It creates opportunity for investors. Know which one you are. Here's the bottom line. Fear feels permanent when it's loud, but liquidity cycles are mechanical. War headlines fade. Oil stabilizes. Markets recalibrate. Position sizing and patience beat prediction every time. When we come back, we'll close this out. Final thoughts on where this market sits and what actually matters over the next 72 hours. We'll be right back.
Our beans are washed in ancient waters, filtered through coal seams deep beneath the Utah mountains. Okay, not really. We totally made that up. But it does sound badass, doesn't it? Here's the truth. Premium Guatemalan beans, aged for 30 days in real whiskey barrels, then carefully roasted smooth in the golden light of California, inspired by the legendary Drunkard's Wash Desert Race in Price, Utah. Bold, smooth, with a subtle touch of whiskey and oak. Drunkard's Wash. Whiskey barrel aged, bold and unmistakable. From Whole Shot Coffee Company. Fuel your life.
All right, final thoughts. Today's market isn't confused. It's defensive. There's a difference. War escalation, oil surging, equity selling, miners reallocating, liquidity tightening. This is a classic macro compression cycle. Bitcoin dipping below $66,000 and stabilizing near $68,000 isn't collapse. It's absorption. It's correlation. It's positioning. In true panic, you don't see stabilization. You see acceleration. We are not there. The real question over the next 72 hours isn't, is Bitcoin digital gold? It's, does oil stabilize? Does escalation pause? Do equities find footing? If energy cools, risk rebounds fast. If energy spikes, liquidity tightens further. That's the lever. Zoom out. Volatility does not invalidate long-term structure. It tests it. This cycle is not being decided by fear tweets. It's being decided by global liquidity mechanics, and those mechanics always reset. Position responsibly. Size appropriately. Understand the difference between trading and investing. And remember, markets move faster than narratives, but narratives always catch up. Appreciate you being here. Appreciate the questions. Appreciate the calm heads in a loud market. This has been your SENB Daily Brief. I'm Sen B'Hiro. Stay sharp, and we'll see you tomorrow. The SENB Daily Brief is a production of Sen B'Hiro Media in collaboration with Whole Shot Coffee, coffee that fuels champions. Written and hosted by yours truly, Sen B'Hiro. Production editing and scheduling handled by Maya Valencia, who somehow keeps me on time, caffeinated, and occasionally polite. Original theme music composed and produced by Paul Hahn, the community legend whose beats hit harder than a Fed rate hike. Research support provided by the SENB community. Proof that sarcasm and spreadsheets can coexist. For more shows, merch, and on-chain chaos, visit senbhiromedia.com. Thanks for tuning in. Stay caffeinated. And remember, if it's not in the brief, it probably wasn't bullish anyway.
Set my wallet free.